episode 18 of The Wealth Show with Equity Kings. Welcome to The Wealth Show. My name is TUMISHO.
I am SIYABONGA, and welcome to the world of finance. And today's topic is going to be about quantitative tightening. And looking at the dates, I think it's almost been 1 year, some months since the 2020 pandemic hit, of which it left economies in a catastrophic manner. So now looking at what the government executed on their economies and what is happening now, because as you guys remember on our previous episodes, we spoke about quantitative easing, of which was a way for the government to prop up their balance sheet to try and save the economy in a so-called manner. But yet it rendered some people at leverage for accumulating certain masses of wealth during. So we are currently in 2022 and the year is opening, and now the Fed is like, I think we've done our bit. We need to go back and revive the economy. Do this now because supply chains have been opened up, not fully, but in a better manner. So obviously governments are preparing to fully recover the economy. So the way and the actions that the federal government has got into place this year, while it's not confirmed yet, there's still some rumor just roaming around the block that says that the Feds might raise interest rates 3 times this year, of which we'd like to see at what percentage will they raise it to, and what effect will it have on the economy. And recently talking, also correlating these two topics, we had an OPEC meeting recently of where we had all the different OPEC company owners and shareholders come together, and then they were talking about how much they want to supply barrels a day, the amount of supply they are willing to give out. And stats are confirmed that US is the highest consumer of oil barrels, going at, I think, 100 and something million barrels a day compared to other countries in the economy. So those two things are underway, of where now oil rigs, I think they're opening up, and obviously there is a need for the oil, so the supply has to be met. But we have certain laws on that because we know how dangerous oil is to the environment. But let me not bore you listeners and deviate from the topic and talk about a lot of things. Our main topic today is quantitative tightening. So we'll just like to dive a little bit deeper into those details and how different is it from quantitative easing and the effects of quantitative easing. So TUMISHO will just dive deeper in the details so we could just lay it out. So over to TUMISHO.
Yeah, welcome guys. Welcome to The Wealth Show. As I said before, but quantitative tightening, let's get our definition straight before we jump to conclusions and saying, oh, is the Fed going to do this? Is the Fed going to do that? I mean, the ECB is following the same plan, the same manuscript, to say the least. So let's get our definition straight. What is quantitative tightening, right? Quantitative tightening. Okay, to explain quantitative tightening, let's go over the basics of quantitative easing. What is quantitative easing? It's when the central bank, in this case, the Federal Reserve, but let's just say the central bank. It's when the central bank buys US treasuries and mortgage-backed securities or whatever asset from the banks, right? From the banks, or you could say the primary dealers. So the primary dealers have a bunch of US treasuries, and what the Fed basically does is the Fed buys those treasuries from the primary dealer banks, and then the primary dealer banks get newly created reserves, which means the Fed prints new reserves out of thin air. Not that they're actually printing paper. No, they're not printing paper. What they're doing is they're just typing on a keyboard, and then they're just crediting the accounts of those banks with X amount of reserves. I am constantly listening to music every single day, 24/7, and the one place that I trust the most is Apple Music. The benefits of using Apple Music is that you can listen to over 75 million songs ad-free with 0 commercials. Plus, Get unlimited downloads to your library and listen anywhere without Wi-Fi or using data. There's no commitment and you can cancel anytime. They have a 3-month special for free, so you can listen to Apple Music for 3 full months for free, and then you can choose whether to pay or not. And it's extremely affordable. So click the link in the description to sign up and enjoy listening to quality music for free. So what are you waiting for? Quantitative easing isn't even a new phenomenon, because Bank of Japan started quantitative easing early 2000s, and then the Federal Reserve continued or started quantitative easing rather in 2009, right? And then the ECB started quantitative easing in 2015. So it's not something new, because Bank of Japan was the first one to undertake this kind of process. So when you think about quantitative easing, it's just a domino effect between these central banks. Started with Bank of Japan, went to the Fed, the ECB came later on, and I'm not sure when the Australian Central Bank and the New Zealand Central Bank started their quantitative easing, but South Africa also undertook quantitative easing in 2020, but very briefly, so not something very significant though. But anyways, what this has to do, what does quantitative easing have to do with repo? Because repo is something very important. It's the plumbing of the financial system. That is what repo is. It is extremely important because that is the funding market. It is a dollar funding market, depending on which country you live in, right? So now that quantitative tightening happens in 2018, when the Fed starts quantitative tightening, what it's basically doing is, as I said before, it's pulling liquidity out of the system, or just pulling bank reserves, because bank reserves are not really liquidity. And you can listen to our episode, our interview with Ryan Miller. He explains briefly, or not even briefly, he goes into depth about why the Fed is not printing money, etc., etc. So that's a good episode to listen to, Ryan Miller's interview that we did on the Well Show. But going back to my point, quantitative easing, or quantitative tightening rather, 2018, they are pulling bank reserves out of the system, right? So what is this going to do to the repo market, right? What usually happens is the repo market is going to have less liquidity. So let's think about this. In 2019, September 2019, repo rates spiked up to almost 10% overnight, because repo is an overnight lending, right, between the banks and the financial institutions. Now that interest rate went up to almost 10%. Boom, in just one day. Boom, overnight it went up 10%. Now, why did this happen? Many people have different reasons. Some people will say it's because when the Fed did quantitative tightening, there was a shortage of cash or a shortage of liquidity, right? So think about this. If there's too much money, that means there's too much demand. And if there's too much demand for for repo, that means it puts interest rates down. That's the whole point of injecting money into the system, to put interest rates down, right? And if there's too little money, there's too little supply of cash or bank reserves. I don't like calling bank reserves cash, because as I said, it's not real money. Banks, it's not, if the money is not relevant. So what happens is, if there's too much cash, interest rates go down. If there's too little cash, interest rates go up. So people are saying it's about cash, whereas I'm convinced that it's more about collateral, in the sense that there's too much cheap junk collateral. Yeah, you were saying, Sia?
Yeah. Just to the listeners who'd like a bit briefer explanation as to what TUMISHO just explained in terms of not wanting to call bank reserves cash. So in essence, the simplest way I could break down the meaning of that, it actually means, for instance, you have a business. So we all know, depending on the scale of the business, a business needs to have margins in order for it to function. So the margins of the business is just the holding capacity of the business for it to yield a spread, of which we'd call profit, or a percentage, after they've sold their good product or service. So in instance, we talk, for instance, like wholesalers. So they've got stock. So that is their margins in the books. So essentially, with TUMISHO's phenomenon, it actually means that these assets are only written down in the form of a ledger. There is no actual assets. But
True.
coming back to handing over to Tumisho, continue with the collateral point.
Yeah, true. So, yeah, I mean that's one way of putting what I'm saying. But going back to the collateral thing, right? So this is collateral is treasuries, which is basically the whole point of this conversation that we're having. Quantitative tightening, selling collateral in the sense of, in this case, we're talking about treasuries, right? So I'm not convinced that it's a problem of too little cash. I'm not convinced about that. What I think is happening is it's not that there's too little cash, and I can hear Sia's dog barking in the background. But it's
I'll just disagree with you, boy. Something is fishy.
yeah. Something is fish. But I'm
Dude,
not convinced that it's too much
dude.
cash. I mean, too little cash. I think because when you say it's about cash, right? Too little bank reserves. I mean, that just makes it look like bank reserves are really necessary and it's real money, because it's not. So what I think is going on is it was a shortage of pristine collateral, but an overabundance of junk collateral. In this case, we're talking about mortgage-backed securities, right? That's the junk collateral. We all know why it's junk, because after 2008, the mortgage market collapsed. So therefore, this kind of collateral isn't worthy of being called pristine anymore. The banks see treasuries as pristine collateral. So because there was a shortage of pristine collateral and an overabundance of, or too much supply of junk collateral, that's what caused the repo rates to go up. So that's not what I'm not trying to argue about repo right now, but I'm just trying to help you guys understand with regards to quantitative tightening. So when you think about quantitative tightening, yeah.
Can I just explain also to the listeners how would an investor use the repo market as a barometer? Okay, so in essence, as Tumisho said, it's a way for the government to collect money, the repo market. So initially, that means that investors throughout the world look at the US economy and they want to invest in the US economy because it's performing in a certain way. But as Tumisho's favorite economist has been saying, Peter Schiff, it's actually dangerous in a sense that since now the government is actually doing quantitative tightening and they're going to raise interest rates. So what that actually means is that investors throughout the world are actually going to see that the United States actually does not have anything to offer, because United States just would deem it as a lazy nation. They're full on leisure, because if you also look, their production went down significantly. Totally importing products and everything, as we've said recently, products
The
and
trade
everything
deficits,
throughout.
the trade deficits.
Yeah. So they've been importing from China because they have all this liquidity in the system of which people have access to without actually it's just a natural consequence. If you don't plant anything, you're not going to yield anything. So these goods and services got to come from somewhere. So what the United States is actually doing is actually peeing in their pants to keep warm. In essence, they're going to get cold a few minutes later, because it was a short-term solution in which they are selling out their reserves.
Mm.
So
Yeah.
it's really interesting to see the future of the economy in 2022.
Yeah, I agree. Although one
And
thing,
and 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 it is January the 23rd today, and Nasdaq closed at a negative 9.12 since November. Its longest losing streak, I think, since 2018, if I am not mistaken. So you see the what you call what the incentive around the market is right now is that these stocks were overvalued, and I think now the chickens are coming home to roost. I don't know what Tumisho you have to say about that, but as we are seeing, all the projections of 2022 have been put out and the stock market hasn't been reacting correctly. And could we be seeing a big influx in terms of volume and volatility into the currency market? of which we know that liquidity slowed down and it went big onto cryptocurrency and into stocks mostly. So do you think we're going to see an influx of all this volume back into currency markets, Tumisho? Because I think we've almost at the end of the era of COVID. Countries are actually in competition now. I think if your country you're going to be laid back by COVID, I think you ought to suffer the dire consequences.
Yeah, I mean, I think with the currency market, first of all, when you mentioned that Nasdaq is down, that seems like, oh, okay, it must be convenient that the stock market has been down since the Fed announced that it's going to be raising interest rates in the future and doing quantitative tightening. I mean, these things, it's all psychological when you think of it, because personally, I think the stock market is headed lower, although unless something changes, but there's no money in this business. What I think is going on with quantitative tightening, people always think about it as if, wow, this is some big thing. Oh, the Federal Reserve is going to crash the economy. No, they're not literally crashing the monetary system because they don't do money. They don't do money, as Ryan Miller tells us. He always teaches us that. They do not do. Wait. Let me finish. They do
destroy the world economy. Sorry to jump into your tongue. They do destroy the world economy in a sense that if you look at OPEC, how many boardmen and cheerleaders are from the United States? As we know that United States is also part of OPEC. And looking at OPEC, what is oil priced in? Oil is priced in dollars. So whatever the Fed does initially does affect the price of oil, of which oil is a global economic supply. Each and every economy's gotta have oil.
That's if.
So
you assume.
How is the okay? Wait, listen. How is the United States not sabotaging the whole train of events? If ever they have a say and an effect on the oil market, of which it affects countries like South Africa, because we know that we are directly connected to the dollar, of which it makes petrol more expensive for us in South Africa. How do you explain that?
No, Sia, let me make my point clear. I'm not saying the Fed has no influence. I'm saying they have a psychological influence, not an actual influence. Because that's if you assume you are talking about OPEC and the price of oil, because the price of oil is in dollars, right? Because of this petrodollar system that we've spoke about many times on this podcast. You guys can listen to our old episodes. But with this petrodollar system, even though oil is priced in dollars, you'd have to assume that the Fed has control over global dollars, this euro-dollar system, which unfortunately it does not control the euro-dollar system. The euro-dollar system is controlled by the banks and dealers within that system that are creating dollars, not the Fed. The Fed does not create dollars globally. It does not create euro dollars because quantitative easing isn't money printing. If it was, they would be controlling the dollar. So the dollar is controlled by all these dealers and all these banks and financial institutions in the euro-dollar global system, in the global dollar system. So that is what really influences the monetary system. What the Fed does is they make it seem like quantitative easing is something big and it's going to change the world, whereas it's just bank reserves. That's all it is. All they're doing is buying or selling bank reserves. It's useless monetary policy. That's all it is. So what they have to do is they have to make us believe that this thing actually works, whereas in reality, what they do does not work because it is not used in the real world. The free market does what's best for the free market at the end of the day. It doesn't matter how many bank reserves the Fed can create. It doesn't mean it's going to create inflation. I mean, it goes back to the inflation argument. People always say, oh, inflation because the Fed is printing money. People like Peter Schiff, oh, inflation. And I must say, I used to be on the inflation trade, but unfortunately, no, I don't believe in inflation anymore. I had a change of heart when I actually looked at the evidence, because if you look at inflation, people are blaming it on quantitative easing. But quantitative easing, where do those bank reserves go? Where do those bank reserves go? Those bank reserves never leave the banking system. And we can talk about this all day, but I don't have the luxury of time. But basically, the Fed is not creating this inflation because it does not know how to, right? Because think about it, right? If bank reserves were truly inflationary, right? If we had too much money in the system, if the world was flooded with dollars, why are interest rates so low? Like the treasury yields, why are yields so low? Why is the dollar up? Because think about it, supply and demand. You print too much dollars, obviously there's too much supply and there's not enough demand for that supply. Then what happens to the price? What happens to the value of the dollar, the DXY, the dollar index? It should be crashing by now. Yet the dollar index, since the Fed started quantitative easing in 2008 December, the dollar index is up 17%. 17%. So it's up 70% despite the Fed printing trillions of bank reserves. Specifically, I say bank reserves because that is not real money. So how could it be inflationary if the dollar index hasn't crashed already? You see, that's one question I'd like to ask to those people who believe the Fed is almighty. It's all psychology. That's all it is.
Okay, cool. It's all psychology. So how do you explain the rise in the living standard?
It's supply chain disruptions.
Supplying disruptions caused by which effect of phenomenon through which quarters?
It's a supply chain disruption because think about COVID. What did COVID do? For example, COVID created heavy demand for online products, right? And online shopping. So that's obviously going to have a huge impact on supply chains. And secondly, it's government lockdowns. So yes, in a way, government is influencing, is one of the reasons why prices are going up because of the lockdowns, but not because of money printing. Has nothing to do with money printing.
Okay, you have to understand the chain of commands in the space of economics, in the space of an economy, in the sense that TUMISHO, whatever policy or whatever the government does will affect the economy in any way whatsoever. Hence, even as you said with COVID, online products skyrocketed to record highs. That was through government intervention.
Agreed.
Let's say hypothetically, if ever COVID had just begun, people aren't really familiar with COVID, and people were not told by the government to sit at home, would the people have sat at home in large numbers and watch their business liquidate and watch their self go into debt and watch their self liquidate their assets? Would the people have done that? My question is no. So we got to see that this was all orchestrated by the government, in a sense that which country was the big leader? Okay, I don't want to get really political, so I'll deviate from that thought. But I feel like you've got my notion on this, TUMISHO. So what do you have to say for yourself?
I have to say I fully agree with exactly what you're saying.
Sorry. And another thing, let's look at the demographics of life, of population growth over time, and then these are hardcore facts. If you look now, we have more millionaires and billionaires than we've ever had in time. Where did that money all come from? There had to be a system in place to create that wealth, and hence the government is doing all this because the government is seeing that there's majority of people who've got power now in the system. So all they want to do is liquidate that power so that people can be obedient because they own the system. So what they do is, essentially the thing they do is just they put an influx in the system so that it can slow down, and then they can delegate new rules and people have to oblige and follow. You catch my drift?
Yeah, I agree completely. I just don't think that when the government was giving people money at home, that money came from money printing. No, it did not. When government spends money, it is just redistributing money. It is not creating new money out of thin air through the Federal Reserve. That's not what the government is doing. So I agree that the government has a hand in it, but think about it. If for some reason a huge demand of retail...
So essentially, I don't know, perhaps somebody could correct me if I'm wrong. Essentially, TUMISHO, what I think is that when the government is doing that, propping up their balance sheet, is that they want to have economic advantage over other nations in terms of they could outsource resources in terms of economic disaster, in terms of economic slowdowns. So essentially, I feel like it's our IOUs for a certain nation to say, hey, we're in a bad time, but we could give you some of this. So hence, as you said, there's no actual collateral moving around. All they did, hence Nixon in 1981, I don't know when was it, but there was a certain law that was signed into that it's too expensive to be transporting gold from United States to Europe on trade. So hence what they did is each nation keeps its gold, and then all they do is they make the transactions through their bank balance sheets. So it's essentially just exchanging assets over balance sheet. So I think that's where the whole system actually fumbled, because obviously someone can play around with the numbers. So hence, I feel like whenever the government is buying into themselves, they're just buying power in times of uncertainty.
True. All they're doing is buying votes. That's all they're doing is buying votes. That's all. And I totally agree. And I think most people who are listening to this podcast would agree with us that okay, this is obvious, this is clear that okay, the government says, oh, the government destroys the economy during COVID, and then they first act as the arsonists, right? They create the fire, and then they come and say, oh, we are the firefighter. How do we put out the fire? Let's give you free money to stay at home. And then boom, prices go up. And then, okay, people say, the government is printing money. But I'll say, no, they're not printing money.
No.
Even though, think about it like this. There's excess demand for goods and services. That's obviously going to bring prices up, but temporarily, because those prices won't stay elevated without new money, without more money, without money printing.
Okay,
so
look,
that's the only way.
And the United States been very good at doing this. Let's look at people like J.P. Morgan. If you look at his story, essentially, I feel like that is when the government artificially started creating things out of thin air, because the Bank of America initially had funds to give to the man to fund his railway, okay, of which it cost billions. So where had America sourced that amount of money at that particular time? The Bank of America didn't have so much reserves. Food for thought. So essentially, the United States, they own the banks, because it's a domino effect. I mean, you could disagree however you want, because even now, look, I feel like everyone is aware that okay, the United States is screwing everyone over, but yet still look at the valuation of the dollar on the international market. Because however way you want to look at it, the price which the dollar stands at today affects how economies exchange goods throughout.
True, but again, as true as that statement is, the dollar has nothing to do with the Federal Reserve, because the Fed does not control the dollar. So that's just my point. That's all I have to say.
Okay. I'm getting lost here. How does the Fed not control the dollar?
As I explained, because the Fed has lost control of dollars going back to the 1950s. And this is again why I recommend the listeners, if you don't buy my story, to listen to that interview that Sia and I had with Ryan Miller. He goes deep into this stuff. So how does that happen? 1950s dollar shortage after Bretton Woods. Remember 1944 when everyone said, okay, let's make the dollar the world reserve currency, or gold, quote unquote, okay, because the dollar was gold.
I just have a question. Then you'll continue. How did the dollar shortage come about?
That's what I'm explaining.
What was the dollar supply then? No, I just want to have those questions. I just want to make you aware of those questions as you go along through with your explanations.
Okay, fine. How does the dollar shortage? As I said, Bretton Woods, they said gold is the reserve currency, but gold is the dollar. So that time gold was the dollar. So the dollar was the reserve currency in 1944. Everyone came together, all these countries came together, and they said the dollar is the reserve currency. And then, boom, fast forward 1950, there's a shortage of dollars because the globalization had, I don't know if it started in the 1950s or whatever, but clearly there was a lot of globalization. So every single country, there was too much trade between all these countries that not all of these transactions could be settled in dollars. Therefore, there was a shortage of dollars because the dollar couldn't meet the demands of the world. The world needed enough dollars to do global trade, right? Because gold, the dollar was kept at gold, at the supply of gold. So the supply of gold was too little to match the demand for the world's whatever the world's trade, right? So what did the banks do? In London, a couple of bankers came together in London and then decided that, okay, let's create dollars for ourselves in the shadows, right? Outside the regulatory body of the Federal Reserve. So basically banks starting in London, they created dollars out of thin air, which were not backed by gold, which tells us that this was the time when to say the least, the gold standard was no longer a gold standard anymore, because now banks were creating dollars without gold, that were not backed by gold. So basically, I would say that's the beginning of fiat currency, not when Nixon took the dollar off the gold standard. That was just official, right? That was just official. It's just something that everyone wants to hear, right? It's not really much of a shock because the system had already evolved from gold. The system had already abandoned gold, because that's what a free market does. If there's a problem, there's a shortage of gold, right? What does the free market do? It finds alternative ways of alternative money. It finds alternative money. So in this case, it was fiat, right? Dollars that are not backed by gold. And so these banks started creating these dollars in the shadows out of thin air. It's just balance sheet mechanics, right? I go to you, Sia. I am bank A, you are bank B. I just go to you and say, hey, I want to have an account with you. And then we just write on a ledger that, hey, this is how much I gave you. I loaned you this amount of money and you have to pay me back. But it's all on a ledger. It's not real. That's exactly what fiat is. We just trust each other that it's like money. It's not real. We just trust each other that, hey, this thing is real, right? The only constraint to money is cash, right? Because someone, if I create a bank loan, right? If a bank creates a loan, right? And then the other bank says, hey, I want cash, right? I want to swap my money on the balance sheet for cash, right? So where do they get that cash from? The Federal Reserve. So that's the only time when the Fed actually has an influence over their own currency is cash. That's the only constraint. But cash doesn't matter these days. Think about it. No one cares about cash these days. Everything is digital. So think about that. That's how the system evolved away from the Federal Reserve. And the dollar itself, the supply of dollars, was created by banks in the shadows, not by the Federal Reserve.
Now, since you're saying everything is digital, do you agree that Bitcoin is the future, sir?
Oh my gosh. Okay, I'll be honest. I don't like Bitcoin, but I believe that a certain cryptocurrency can be the future, just not Bitcoin, because it's too volatile and whatever. And I don't think, even if it improves one day, I mean, there's going to be speculators all over it. So in my opinion, Bitcoin has too much demand from the wrong people. That's the problem. That's a problem. If Bitcoin was stable, maybe I'd support Bitcoin, but I have no problem with the cryptocurrency technology, blockchain technology. But that's basically what it is. It's literally the same thing as euro dollars, right? Dollars that are created in the shadows. That's all it is. It's a free market approach to solving a shortage. Think about it. 2008 financial crisis. Then suddenly 2009 Bitcoin emerges out of nowhere. We believe that it emerged out of nowhere. What should ring in your head is, okay, Bitcoin emerged during a dollar shortage, because that's exactly what the 2008 was. It was a dollar shortage. That's why if we didn't have a dollar shortage, we wouldn't have a crisis, right? Because think about it like this. Your assets are going down in value. The housing market is collapsing. Obviously, you need liquidity. But if there's no liquidity, you're going to go bankrupt. You see, so it was clearly a dollar shortage. Now, Bitcoin is trying to solve that dollar shortage. I just don't think it'll efficiently solve that shortage. That's my take.
I feel like that's an argument for another day. I
Yeah,
said
yeah.
Bitcoin is still in its developmental stages.
Yeah, true, bro. But that's it for me. I don't want this to be long, but that's it from me. I have nothing else to say unless you have something else to say, man.
Thanks for tuning in, listeners. It's 2022. I hope you're going to keep your head focused. Thanks for tuning in. This is SIYABONGA Chuma. Catch you on the next episode.
Yo, thank you guys. Thank you guys for listening to us and supporting us. There will be another episode. We'll be talking about Bitcoin more frequently on this podcast. So thank you guys, and we will see you on the next episode.